Hello and welcome to Chapter 2, the Professional Standards in Auditing. So in Chapter 1 we talked about the agency that has been created after the Enron debacle, which was the Public Company Accounting Oversight Board. Of course, this board was established by the Sarbanes-Oxley Act of 2002, okay, and it's called the PCAOB. It is made up of 5 individuals appointed by the Securities Exchange Commission. So in a way, this PCAOB reports to the SEC, the Securities Exchange Commission. The job of the PCAOB is to set standards for auditing, attestation, the quality control, and independence and ethics for audits of public companies. Okay, that's important. They are only to audit public companies. Independence and ethics for engagements involving non-public companies is established by the AICPA. So the PCAOB only applies to the large businesses that trade on Wall Street, but the small mom and pop auditors that do auditing for small businesses still governed by the AICPA. All right. Now, GAS, as we said, generally accepted auditing standards. These are the 10 broad standards set forth by the Auditing Standards Board of the AICPA. And they have those general standards. What are those general standards? The first 3 standards, commonly referred to as general standards, are that auditors, when they do an audit, should have proper training and proficiency. Okay? They must have independence in mental attitude. Means they should not have any conflict of interest. I have $1 million worth of investment in any company. Obviously, I cannot be auditing that particular company because I cannot be independent. Okay? Properly trained, independence, and do a professional job. Professional care is to be exercised. First 3 standards. And they're called the general standards. You'll see a few multiple choice questions on this. Then you have the standards of fieldwork. The next 3 standards are referred to as the standards of fieldwork, and they are: auditor must adequately plan and properly supervise work. Proper supervision. Okay? Very important. Obtain proper understanding of the entity and the environment, including internal control, to assess the risk of material misstatement and to design further audit procedures. What do we mean by all this? If I am going to be auditing a manufacturing company, a food manufacturing, I have done some audits of food manufacturing in the past. If I am going to audit a food manufacturing company, I need to obtain sufficient understanding of that entity and the environment, okay, including the risks of material misstatements. What can go wrong? What kind of an entity is this? What are the risks involved in this business? If I'm going to be auditing a high risk industry like the tobacco industry, I better know what the industry is all about and the environment. Highly competitive, okay, highly regulated. I need to have a proper understanding. That's what this means, okay? No audit is good enough without evidence. Just like a judge cannot deliver without evidence, a judgment, an auditor cannot come up to an opinion without evidence either, okay? Proper evidence has to be obtained to provide a reasonable basis for the opinion. Then you have your standards of reporting. So, general standards, who can be auditors? Standards of fieldwork, on the fieldwork, what kind of work is required? And then when you do the reporting, what do you need to adhere to when you do the reporting? State whether they are presented in accordance with GAAP. Identify circumstances in which such principles have not been applied. If you have deviated from GAAP, there may be a good reason for it. Why? And identify those reasons. Proper disclosures. Okay? And what the amount of responsibility you are taking versus what is the job of the management. 10 standards of auditing. GAAP versus GAS. Prepare financial statements in accordance with GAAP. Management, audit them in accordance with GAS, generally accepted auditing standards, those 10 standards. Management, auditors. Okay? So what's the auditor's responsibility for detecting material misstatements? Reasonable assurance. Auditors should exercise due care in planning, performing, and evaluating the results of procedures and exercise proper degree of professional skepticism. We talked about this. What does this mean? You know that thing about trust but verify? Over here, only verify. It's not that you don't think people are nice or people cannot be trusted. It's that your job is to collect evidence. Strictly professional, nothing personal. Okay? So, professional skepticism so that material misstatements due to error or fraud can be detected. An auditor should also plan an audit so that illegal acts that could have a direct and material effect will be detected. Direct and material effect. Important. Okay, highlight that please. Okay, direct and material effect. Your audit should be able to catch those illegal acts. Okay, of course, you're providing what kind of evidence? Reasonable evidence. What kind of assurance? Reasonable assurance. Now let's read this. Companies retain auditors so that they can get a clean report, an unmodified or a report that has no qualifications, which we call our unmodified report. Okay? That's what they want. That report is an opinion, not a guarantee. Whoever retained the auditors, to them the report is addressed. And two kinds of standard reports. One if you audit a non-public company, one if you audit a public company. So what kind of a report is issued when you audit a non-public company? It should clearly state at the top, independent auditor's report to the audit committee, because they retained you, then that's whom you should address the report to. The first paragraph. Read this very carefully. Okay. What financials you have audited for what year? What is management's responsibility? This is what they are responsible for. Management. What is your responsibility? Reasonable assurance. What are you doing? What kind of work you're doing? Opinion. Okay? Final paragraph, opinion paragraph. In our opinion. So that's the general report, the kind of report for a non-public company that small businesses tend to aim to achieve or aim to get. Okay? Now, as you know, slowly we are trying to move towards IASB. Okay? And they have a report also, the International Accounting Standards Board report on page 53. Let's go to page 53 in your textbook. Seems like there's a typo here. Should be page 57. Okay? And it's right over here. Again, not a whole lot of difference. Okay, so you should review this report as well. And it's very similar to the one that we have seen above. Okay, and I apologize for that. This should say page 57. And here is for a public company. An additional paragraph that talks about internal control. Very, very important. Okay, these reports need to be reviewed, carefully studied, because you'll see some multiple choice questions on that. Okay, so the primary difference in the two reports is that auditing standards generally accepted is replaced by standards of public company accounting board, and a final paragraph is added, okay, on internal control. So this is basically the primary difference between the two reports. You may see some questions on that. All clients want an unmodified report, but it's not possible in many cases. I should not say many. In some cases, rare events, a clean report may not come. In the real world, all differences between management and auditors are usually reconciled, okay, because management will basically be told, do this so that you can get your clean report, restate the financials, make proper journal entries, recognize certain things, do certain disclosures. All this is part of an audit, and then once it's done, usually you get your clean report. But in many cases, again, I used the wrong word. In some cases, you may not get the unmodified or the clean report. Then you have other kinds of report. You're not able to verify everything due to some kind of a scope limitation. Then you may need to qualify. States that financial statements are not presented fairly, adverse, that's qualified opinion. Okay, my fault. Some limitation is qualified. When you find that financial statements are not presented fairly, you provide an adverse opinion. Generally, this means management folks are a bunch of crooks. Very, very rarely given, because it's of no use to the client. Okay. Disclaimer of opinion, huge scope limitation that prevents you from coming up to an opinion. Some scope limitation, so you qualify that this much part I'm qualifying, other than that everything looks good. Disclaimer, I cannot provide an opinion. Okay. Now, if you know that something is wrong, you have got to say something is wrong. It is important to understand the difference between an adverse opinion and a disclaimer of opinion. Disclaimer cannot be given as substitute for an adverse opinion. You need to understand that very clearly. Okay, you cannot say, I like these people, I know they're a bunch of crooks, I like them, I don't want to give adverse, let me just say I don't know. No, you cannot do that. You have to say exactly what what the situation is. If it is adverse, it's adverse. Okay, now as we move on, let's talk about peer reviews. I am an auditor in Illinois. I, as a matter of principle, only do one audit a year because of the fact that I do not have the time, as I'm a full-time professor, to do more audit, but I need to do one to kind of stay in the industry. Okay, in Illinois, the peer review has been implemented since the last 3 years. What is a peer review? A peer review means all CPA firms, big or small, are required to maintain certain quality control procedures to provide reasonable assurance that it follows professional standards on every engagement. CPA firms that are in public practice are required to have a sample of their work reviewed by an independent party. What do we mean? I need, as a single member audit firm, I need to invite outside CPAs who are peer reviewers to come and assess the quality control of my firm. Okay, and there are two types of peer reviews: system review, engagement review. System review is more detailed in scope. When you do audits, You do system reviews, which means much more detailed in scope where the quality control procedures of a firm are assessed. This is the kind where an outside CPA is invited to your office and they come in, they look at all your work, they at least look at one audit as an example to see what you have done, and then you have an engagement review where if you are not doing audits, there are many single member audit firms, small firms that are now getting out of audits, and it's become more of a big firms kind of thing. And what they do is they only do reviews and compilations, lesser in scope than an audit, right? Review is limited assurance, compilation is limited to no assurance, okay? So in that event of an engagement review, what you normally do is you simply take your work and send it to an auditor who will look at it, and then they will basically pass you or fail you. Okay, 3 ratings: pass, pass with deficiencies, this is clean, this is what I get, and this is what I aim to get. Pass it, there are some deficiencies that need to be worked on. And fail. Fail means your quality control is very poor. Okay, outside firm comes in and does peer review, is what we call a peer review, peer-reviewed firm. Okay, so that's in a sense chapter 2. Very important to understand the 10 principles, okay, of generally accepted auditing standards. Understand the difference between reports of non-public and public company. All right. So once you do this, I think you are ready to tackle the multiple choice questions. With that, we conclude our discussion for chapter 2.